It's the perfect time to have the conversation, really, about the bull market, turning 10 this weekend. Our next guest had a front row seat to the beginning of the current run. Bob Diamond, the former CEO of Barclays, now runs Atlas Merchant Capital. It's a firm that specializes in investing throughout the financial services industry. It's good to see you.
It's nice to be here,
So
Scott.
this weekend we are, marking a decade of the bull market, the bottom famously called by our former colleague Mark Haynes. Let's revisit that moment, and then we'll talk about it on the other side. Here's Mark Haynes.
However, I'm going to step out on a limb here.
This is the big, hold on, everyone. We've been waiting for this.
I think we're at a bottom. I really do.
I think we're at a bottom. I really do. He was right. The question is, do you think now we're closer to the end of this decade-long bull run?
There's no easy answer to that, but I do have to go back to Mark's comment. I was nowhere near as optimistic as he was at that moment. I think it's hard to overstate how deep and how dark that correction was. Probably the most severe of any correction since the Second World War. I think the S&P was down something like 60% from peak to trough in a 3 or 4 month period. I think funding for financial institutions was really, really challenged around the world. So to think that we're 10 years on now and that we've had a recovery that we've had with the S&P up now, what is it, 4 or 5 times with a strong, as strong a private sector in the U.S. as we have. I think it's a bit of two stories, Scott. I think in the short to medium term, when you see the strength in the underlying private sector in the U.S., it's hard not to be impressed. My own view is by the second half of this year, we'll be raising rates again in the U.S. And on the other hand, there's some real storm warnings out there, particularly around credit. The explosion of credit, which was a direct result of the very, very positive monetary policy that was instituted first by Governor Bernanke here, but also by the ECB and by the Bank of Japan.
That's an interesting point of view. It's contrarian, really, to what we've been hearing. If you're looking for rate hikes in the second half of the year, the prevailing view now is cut because things are dicey and there's weakness around the world, and it's going to wash to these shores sooner rather than later.
Yeah, and I think the very, very fast action of Governor Draghi, as you mentioned yesterday, is very, very important, because I think a lot of the positives that I'm mentioning about the U.S. private sector, I wouldn't be saying about Europe. And I think Europe has more growth challenges. And I think the fact that Governor Draghi moved as quickly as he did to basically say, we're going to do what we need to do again across Europe was very important.
Are you worried about the European banks?
How can one not be worried? If you look at, we're investing in European banks, but we're investing in European banks where we can find platforms without non-performing loans, without legacy technology, where we can truly get business into the economy. So if you look at Greece as a good example, we have a bank there called Praxia Bank, which is a challenger bank. It has no non-performing loans. But if you look at the 4 systemic banks, and in the case of Greece, the 25 banks that were in Greece 10 years ago are now 4 that were just consolidated into those 4. The non-performing loans in those 4 banks are over 60%, and we're 10 years on from the crisis. So how can one not be worried about banking?
Greatest mistake of all time, so to speak, was for the European banks not to recapitalize in the way that the U.S. banks did. And in some ways, they haven't even taken their full dosage of medicine to this day.
Scott, what a great lesson, though, we have had. If you look back 10 years and you look at two of the strongest banks in the U.S. today, Bank of America and Citi, both were close to insolvent. TARP, which basically said we're going to give all of the systemic banks more equity than they need. You're all taking equity, good, bad, indifferent, no stigma. 2, you can't pay that back to the government until you pass our stress test. Translation, until you clean up your balance sheet. And oh, by the way, until you pass the stress test, you can't pay bonuses and you can't pay dividends. 10 years on, we have a very strong financial system in the U.S., and Citi and B of A are both thriving, both here domestically and internationally. And we have the issues with Deutsche, the issues with Royal Bank of Scotland, still across Europe. It's a great lesson.
Do you think that in hindsight, something that went little remarked at the time, but what might have actually been the proximate cause of the bottom, right around March 9th, the lowest point for the S&P, you also had the suspension of mark-to-market accounting FASB 157. I think they put it on ice, and they said the banks no longer have to call all of this a loss. They have more time now, and that seems to have coincided with the banks, the share prices of the banks not going down, and maybe even triggered a CDS rally. Do you think that was a really important component? And if so, should that be a policy tool going forward for financial crises?
I think it was far more important at the time, to be honest, that the TARP program was implemented and that there was real equity. The attitude that the U.S. took was, as angry as we are about the crisis and the role that the banks may have had, we need to fix the system. We're not going to have an economy without a thriving financial services industry. Where in Europe, it was a bit more, this is a pejorative comment, but it was a bit more around biblical justice.
Yeah.
You know, let's get them, as opposed to thinking about the system. And I think the U.S. led the way, and today you can see the clear differences.
You look back at that period and you say, and many do, Bernanke and company saved the world. How do you think Powell and company are handling things today? He's a different kind of central banker. They've made this great pivot, if you want to call it that. Are they on the right path?
Yeah, Scott, in my view, notwithstanding the things I said about the private sector, it clearly slowed down in the fourth quarter, and I think Chairman Powell responded to that. But I also think Chairman Powell believes that if we don't get back to a more normalized level of interest rates and a more normalized yield curve, and by the way, we're still at kind of 2%. So, we've halted here, but we're not even back to what people would consider to be normal of 2 3/4 or 3%. If we don't, then when the next challenge comes, and there will be a challenge, we're 10 years on. This is the longest recovery since the Second World War. 10 years on. So when we do have a challenge, do we have any monetary policy tools? Do we have any fiscal policy tools? And keep in mind, we just spent $2 trillion on tax and spending. So we've kind of wiped out the fiscal response that we can have for a challenge, and we're still not where we need to be to have monetary tools. So the question we have to ask ourselves is, how prepared are we for the next challenge?